There are a number of sources of catalytic capital or early stage capital for climate finance projects. Often they can come from government or bilateral donor agencies. And these are often grants or technical assistant grants that are provided to bring down the cost of what it would take to kick off an investment or develop the capacity to deliver the work on the ground and structure finance. There's also, and this can come from sort of the national level, state level, country government to country government. And it can include things for research or development, also pilot projects and other kinds of initiatives that otherwise wouldn't be able to take off. There's also philanthropic capital, which is we're seeing a lot more of these days. Philanthropies are providing catalytic finance, so very low interest rate loans. That's often in the realm of impact investors. And oftentimes you'll find philanthropies are providing sort of catalytic grants as well. Also, international development finance institutions or the multilateral development banks, they're a major source of climate finance and particularly blended capital. They can provide risk-sharing instruments, first loss, to crowd in the private sector. They do things called default swaps as well. And junior equity or subordinated equity can be also provided by these bilateral development finance institutions or multilateral development banks. And yeah, a lot of the time this comes in the form of concessional loans. And then you have your UNFCCC instruments or funds, such as the Green Climate Fund or the Global Environment Facility, the Adaptation Fund, and the Climate Investment Funds. And these can provide project-based finance that's usually at a concessional rate. And they use all the same instruments that you would, the multilaterals, development banks, or the development finance institutions would use as well. And then, of course, there is private investments and private, not often private financial institutions providing catalytic or concessional capital, but they're expected to form a part of a blended finance transaction, which might involve funding from a bilateral donor, a climate fund, or a development bank, and they're looking to crowd in that private capital, those private investments. So the sectors or the types of projects that require blended finance are those that typically are not commercially viable, that have some kind of public good element in them. That could be adaptation to the effects of climate change, the benefits to populations, or it could be mitigation, which is the reduction of greenhouse gas emissions. These projects bring a public good that sometimes is monetizable and sometimes isn't monetizable, meaning it can create a commercial flow of capital back, and sometimes they don't. But most of the time, that commercial flow, that income from those investments, isn't enough to make it commercially viable so that a private financial institution would actually go and make those investments. Now, the types of sectors that would be in the energy space, it could be in industry, it could be in the electricity sector, and that would be in the industry sector, for example, it would be for an investment in energy efficiency. So let's say, and that would mitigate greenhouse gas emissions and reduce energy costs. And in the electricity production sector, that could be a renewable energy investment. Both of these do create a revenue stream, but sometimes that revenue stream, as I said, isn't quite enough to make that project actually viable. So blending finance from public and private sources would make that viable. On the other hand, on the adaptation side, you have adaptation and resilience projects. These quite often have a very high sort of public good benefit that isn't often, financially, it wouldn't benefit a private investor. So therefore, we need to bring in more of that type, or more of that cheaper concessional capital, that grant capital, that brings down the cost of investment and brings up the returns potentially. And that could be for agroforestry, climate smart agriculture, which is adapting agriculture to the effects of climate change. It might be for water access, or other things that protect populations, such as housing and infrastructure. Green infrastructure as well. back to the mitigation side is a major piece, and that can be EV vehicle infrastructure for charging stations and things like that. Whilst they can become commercially viable, oftentimes they need this proof of concept or have a high upfront cost of capital, and it's that high upfront cost of capital that prevents these projects from being viable in the first place, and they need funding because of these longer sort of payback periods. The blended finance itself really helps to reduce the risks that are faced by private investors in many of these emerging market environments. And besides that, blended finance doesn't just need to be for climate change, for adaptation and mitigation. It can also be used for healthcare and education. And there are many sort of public-private partnerships that can be formed around those types of investments as well. There are a number of conditions that need to be put in place to bring in private capital or crowd it in that governments can support. Namely, the first one is a conducive enabling environment that attracts private investment. This is usually done through policy or regulatory means. In terms of policy, a clear climate mitigation or adaptation targets with gaps identified, and then incentives to bring in that funding into various types of projects. It's good to boil that down at a sectoral level and have sectoral plans, which include the private sector being, providing funding and also being part of building out the solutions. So not only do we want incentives that crowd in private capital, but also create the enabling environment for businesses that are servicing these sectors to thrive. That could be project developers in the renewable energy space. It could also be people that are training agricultural experts and farmers that are helping to train people in this space where they're adapting their agricultural activities to the effects of climate change. In terms of fiscal incentives, the Ministry of Finance or central banks can establish transition plans for the financial sector. Regulators can regulate banks within the various sort of areas to help reduce to incentivize the reduction of greenhouse gas emissions across various sectors. Access to finance is also another, access to appropriate types of finance is also another sort of enabling environment condition, and governments can make sure that public financial institutions can provide concessional capital. For example, there might be a sustainable infrastructure development bank in a country, there might be an agricultural development bank, and they can create sort of financial mechanisms by which they can crowd in private capital, both domestic banks or investors and large-scale foreign direct investment through reducing the risks of investing in that environment in the country and also reducing the cost of capital and increasing access to finance. The governments can also work in the area of sort of capacity building to build up the capacity of local financial institutions. They can also work with project developers to help build their capacity to develop pipelines of projects. And this is usually through a project preparation facility or technical assistance facility that targets particular areas where capacity needs to be increased and can develop that sort of enabling environment. And then a sort of final piece that really needs to be focused on and is often forgotten is the absorptive capacity. Once these institutions or private actors in country receive funding, it's how to actually deliver that. It's the budgetary management of that funding and reporting on the use of those resources, which also help develop that sort of enabling environment that crowds in private capital. There are a number of challenges for securing investment in climate solutions, particularly astute in emerging and developing markets. The first one that you'll hear the most about is high perceived or actual risk of investing in those environments. Things such as political risk, risk of defaults, defaulting loans, which create diverse incentive to actually invest in these environments. high transaction costs, so the cost of every single transaction is higher in some emerging markets, whilst there's also sort of at the same time unfavorable or sort of slow regulatory or policy frameworks can also create a bit of a disincentive for investments. Quite often there is a lack of bankable projects. That these can be overcome through the likes of project preparation facilities and de-risking facilities, but there's a very clear need to develop capacity in country to deliver project pipelines and build those out and support the development of the local capital markets as well. There's often limited public resources within countries to actually provide the funding to those countries to deliver projects. And also a lack of concessionary capital or risk capital that will reduce the risks of those investments. And then finally, a lot of these projects can have unpredictable cash flows, whilst renewable energy is obviously not a good example of that because it can be quite predictable. There are other projects with nascent technologies that may or may not have predictable cash flows. And that can be sort of overcome with risk-sharing instruments, catalytic finance, and blending public and private resources. Yeah, blended finance can be an option in most economies, but in certain situations, in certain sectors, it's a lot more difficult and really depends on sort of several factors. The first is the availability of public or concessional finance that helps to bring down the cost of capital. It's a really crucial factor, and if there's limited public finance or blended finance available, then projects can oftentimes not be feasible. Also, the maturity of financial sectors, the liquidity of markets, and the available instruments of financing investments in mitigation or adaptation are a really important factor. And if they're missing in some markets, then there just simply isn't an option. And that's why sort of technical assistance and capacity development and market creation are really important to sort of overcome those issues. Blended finance itself is a complex thing to undertake. The delivery of projects, writing term sheets, structuring mechanisms, identifying the risks that need to be shared and who needs to do those, and then what type of capital is the most appropriate for each investment is oftentimes very difficult. And sometimes these markets, particularly lower income countries, don't necessarily have the number of experts required to scale up the use of blended finance. So if the financial sector is less mature, it's quite difficult to handle blended finance instruments, and they might not be a viable option in some cases. The nature of the project itself actually plays a really crucial role as well. Blended finance is typically used only to fund projects with a strong social or environmental impact alongside financial commercial returns. So those are sort of factors that need to be there. And then the risk-return profiles of projects are also a really important piece in this, and they sort of play a key role in whether determining blended finance is actually an option or not. So both public and private investors need to be on the same page, need to be working together, and agree on the appropriate risk-sharing structure and rate of return on their investments on both sides of the public and private. Yeah, there are a number of recommendations and sort of key points where public institutions and governments can use blended finance to leverage private capital. And I mean, first of all, it's creating that enabling regulatory and fiscal environment so these investments are actually possible, sending the right signals to the private sector that the government is serious about decarbonisation or about adaptation programs. And is providing appropriate financial or regulatory incentives to do so for those private investors, both domestic and foreign, that want to invest in the country. Governments also should really be using and are oftentimes very successfully using their public finance strategically to de-risk projects and attract finance. A number of emerging markets and developing economies have very successful programs and development banks that have mobilized private capital up on par with that of the multilateral development banks and development financial institutions. But it's important that any program of public funding used is used strategically to try and leverage the highest amount of private capital possible and doesn't actually crowd out private finance, private investments. Governments can also leverage international institutions such as multilateral development banks, development financial institutions from other governments, and various funds like the Green Climate Fund, the Global Environment Facility, or Adaptation Fund. Whilst it's difficult and it's a long process to get projects financed through many of these instruments, that is certainly one of the main routes to go down. Plus also forming relationships with international private financial institutions that have a significant level of assets under management in emerging markets would be a sort of smart move there as well. And also governments can really work together at a sort of a country platform level, both bringing in the international actors, their own public institutions, financial and sort of regulatory, as well as domestic actors to bring together everyone, all stakeholders around particular sectoral pathways, either for adapting to the effects of climate change or reducing emissions, bringing everyone together to work together, identify problems, to come up with ways to solve those problems, and then identifying the most appropriate uses of concessional or public finance to catalyze some private investments. What are some of the most strategic uses of catalytic capital? Well, last year we had announced the largest single dedicated commitment to a blended finance transaction, and that was the Indonesian Just Energy Transition Partnership, or the JETP. And that's a sectoral-wide decarbonisation mechanism that is used to phase out coal-fired power plants or coal assets. That brings in both public sector funding from donor governments such as the US, Germany, France, and the United Kingdom. It also brings in a number of private financial stakeholders through GFANZ, which is the Glasgow Financial Alliance for Net Zero, and they bring in a lot of international banks, institutional investors. What they're using that funding to do, they're blending both the public and the private funding to shut down those coal assets early. It's under a countrywide platform or a mechanism which has many blended finance structures or investment vehicles underneath that, and they work on things like the phasing down, but also the building out of new renewable infrastructure, battery storage technologies, and the transmission structure that is necessary to replace the coal with clean energy. So the types of projects that lend themselves to catalytic finance are those that have a public benefit, right? And that public benefit could either be the reduction of greenhouse gas emissions, local pollutants, environmental degradation, or it could also be a benefit to help adapt to the effects of climate change. And I'm solely speaking in the realms of climate change here. The types of projects that would typically be financed, for example, one might be used to reduce methane gas emissions from agricultural production, from food production. That would, the funding could then be used to create biodigesters where that methane gas can be stored and then either flared or used to produce electricity. Other types of projects might be an agroforestry project that helps, and agroforestry is where you combine agriculture and forestry together for the sort of to bring out the best benefits of using forestry and agriculture in the same space for mitigation and adaptation benefits. And that could help small farmers adapt to the effects of climate change and soil runoff, and land degradation from other sort of various means that strip the nutrients from soils. Another type of project that might be a good example is a renewable energy project, a microgrid project where people either have intermittent access to electricity or don't have access to electricity at all. It means that you can build out that small microgrid and give access to electricity to a community. But it can also, blended finance can also be used and is very often used at large scale, utility scale transmission and transmission infrastructure build out for renewable energy, where the project is not actually yet commercially viable and just needs a little bit of risk sharing capital or technical assistance or grant funding to help that project take off. Some of the things that countries can do to attract financing is really try and develop their own capital markets first. The country really, and many countries have been doing this in terms of building out, the liquidity in markets, restructuring the sort of financial sectors and creating a fiscal environment that's conducive to investment, that private investors within the country are happy to operate in and reducing the risk of investment. Also, to crowd in international finance, the governments can work with development banks and other private financial institutions to identify projects and potential investments and barriers to those investments, and work together to address those through catalytic finance, or also a regulatory, creating new regulations and a regulatory environment that is conducive to investment. So the Indonesia JETP, up until this point, it's hard to tell if it's been successful because no investment has actually changed, no money has changed hands. We have commitments. But what made that case successful, and because it was such a large transaction, I think around 23 billion, sorry, not transaction, a commitment, around 23 billion, was bringing all the actors into the room and trying to create that environment where there is trust, which is often difficult when it comes to these kinds of international negotiations. There needs to be a lot of technical support so that so that governments can trust each other. Sharing information and analyzing sort of at the asset level, at the individual asset level and all at the portfolio level, setting plans together about how it's going to work, and creating an investment pipeline of potential coal-fired power plant assets that will be phased out earlier than they should be. All of these things contribute to sort of building that trust without which such a large scale commitment wouldn't have ever been possible.